It was a solid snapback rally for the market today with the S&P 500 up about 0.75%. We were actually led higher by some of the areas that have been blitzed the most here recently, namely a lot of those defensive areas like consumer staples and utilities and REITs. In fact, we'll kind of dig into the details on the utilities and find that just one utility finished lower today, which was the exact opposite from Tuesday when just one utility finished higher. So a little bit of a reversal of fortune there for some of those areas, but sadly many of them remain in downtrends, and so we've got a lot of work to do. Our postures largely remain bearish as well from an intermediate perspective. However, we do see some nice bullish near-term divergent signals in the short term popping up on a number of the different indices, and that will play a role in tonight's trade application example where I'm doing a bullish swing trade on a well-known tech stock that seems to be bouncing up and off of its rising 30-day moving average right now. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 2nd, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way we can be notified whenever we post these videos. We also have the stocks giving you overbought and oversold cluster signals within the S&P 500 listed at the bottom of those emails. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us to give us a lay of the land. And for the most part, a pretty promising day for once. Kind of feels like we've had a lot more of those sell-off days here recently, but this one was definitely in the camp of the bulls. And you can see that the overwhelming evidence supports that. You do have one sector, at least from my eyes perspective, that kind of stands out in the opposite direction. That would be the financials. Notice the financials mostly in the red, especially the banks, right? Some of the asset managers and other capital markets types of stocks did a little bit better. But the big banks like JP Morgan and Bank of America and Wells Fargo, Truist, PNC, M&T Bank, Citigroup, US Bank, all of those were down, and in some cases quite significantly. So there seemed to be a little bit of pain there in the banking world today. Had a little bit of red in the financial, not the financial, but the healthcare area as well. But there it was a little bit more offsetting, I would say, because you did have some of those pharmaceutical stocks coming back a little bit here today with Eli Lilly and Pfizer up here. Remember, those particular stocks have been getting smashed here lately. We talked about that a little bit on Tuesday night's video. So it's good to see a little bit of a snapback there. Not a huge one, but you got to start somewhere. So a few more of those healthcare stocks are starting to pop up there. But other than that, it was pretty consistently green across the board. Now, one stock that probably catches your eye is Tesla, off to the right-hand side here. It kind of stands almost all alone off in the right-hand portion of this heat map by not only being a large square. Of course, those of you that have watched this long enough will know that the larger the square and rectangle, the larger the company's market cap is, and therefore the more important its weighting is within the S&P 500. So, of course, Tesla is going to be one of the most important companies in the market these days, and was clearly the worst performing company here today, not just of the big and mega cap companies, but it was literally the worst company in the S&P 500 today, down about 6%. And that was largely because of a little bit of a fizzle from Elon Musk and company here last night with their investor day presentations. Apparently, the market didn't see too much to get excited about in that regard. So a bit of profit taking there. Remember, Tesla has had an enormous run of things here earlier this year. In terms of those stocks that are in the green, it's hard to pick and choose because there's so many of them, but I suppose it's worth at least pointing out the bigger movers of the day. CRM was the king from that perspective. They were up about 11 or 12%. This is Salesforce.com. Remember, that company is in the Dow now. A lot of people forget about that because it doesn't really seem like the Dow type of stock. In fact, we were talking about the Dow stocks in my question and answer session today. And there's only 3 stocks in the Dow that do not pay a dividend. Salesforce.com happens to be one of them. And so it had a huge day for it, up in the double-digit percentage territory. We did see Dexcom also have a very good day in the healthcare space, up nearly double digits, just shy, up about 9% there. And some of the other movers, Take-Two from a video game perspective was up quite a bit today. Mosaic was up quite a bit in the materials and fertilizer play. And a handful of others. Kroger catches my eye. Of course, a fairly well-regarded grocer here in the United States. It was up over 5% today. Not bad for a boring old grocery store company. And we did have a snapback in some of those areas that we were saying on Tuesday's video were just getting smoked, and that was utilities and REITs. Remember, we were talking about how utilities had just one single stock that was up on Tuesday. Well, today it almost feels like it was the exact opposite. As we zoom in on the utilities, it looks like we only had one stock that was down today, and that was NRG Energy, which was down 0.82% today. But otherwise, every other utility was in the green here today. So kind of interesting to see how it shook out that way. Where we had nothing but red except for one green on Tuesday. Today we have nothing but green except for one red within the utility space. The other one that we were looking at on Tuesday was energy, and remember, every single energy stock was down on Tuesday. Today we had a nice reversal of fortunes there as well. We didn't have a clean sweep for the bulls. Nonetheless, looks like we only had Phillips 66, Diamondback Energy, and yeah, it looks like it was just those two that were in the red here today. All the rest of them were in the green. So with those two areas getting smacked so hard on Tuesday, it was good to see them both rebound as well as they did here today. But again, it was pretty overwhelming today. No matter where you looked, you probably found more green in your portfolio than red. So all things considered, a nice little day there for the bulls. Let's go ahead and see what the actual breadth numbers are now. And I've got the S&P 500 pulled up here under the Market Watch Visualize area. 381 stocks within the S&P 500 closed higher today. That's good for about a 76% hit rate there. Again, pretty overwhelming that today was one of those very nice days for the bulls. All right, let's go ahead and now come on over to the main part of the platform and take a look at our charts here. So this is chart 4B. A reminder that this is a 4-grid that will look at the 4 major U.S. equity indices, and the background colors of the charts over today's candle will tell you what the posture is using the Market Forecast Technical Indicator. Those of you that are premium members of Market Scholars, of course, have access to all 50 plus of our charts that you'll see David and I using in our presentations. But today, we did see the bulls back in action. However, it was not enough to offset the bearish postures from an intermediate perspective that have already been kind of set in place. Let's go through the evidence, and you can see here the S&P 500 was up 0.76% today, so a pretty strong day. The Dow was actually today's leader, up over 1%, and that was probably because of Salesforce.com. Remember, the Dow is a little bit different than the S&P 500 in that it is price weighted, not market cap weighted. And with Salesforce having a stock price of just under $200 a share, it's going to have a somewhat bigger influence within that 30 stock index. So I would venture to guess that a big chunk and the big reason that the Dow finally was able to have a leadership role today was as a direct result of one stock that happened to be firing in all cylinders here today off of some new information released to investors. Down below, you'll see that the NASDAQ was up 0.73% today, so pretty much in line with the S&P 500. And then the Russell 2000 was actually today's laggard, just up 0.22%. And notice the background colors of all 4 of these charts remain with that dark pink shading. And in these cases, it means that we do have strongly bearish postures. For the Dow, the green intermediate line is actually still in the low reversal zone, despite today's nice pop higher in price. With the other 3, you can see that the green lines are simply traveling lower between the 80th percentile and the 20th percentile. And when that is is the case and it's traveling lower, especially when it's below 50, we would consider that to be strongly bearish. And so that does describe those other three charts that we see there. The other thing that kind of brings those other three charts together is that all three of them have a yellow moving average. Now remember, we use a 30-day moving average in these particular charts. And so what this is saying when it's yellow in this case is price is below a rising 30-day moving average. So there's a little bit of conflict there. You don't have both things bullish. You don't have both things bearish. You have two opposing ideas where we're trying to discover where the market wants to go next. For the Dow, it's a little bit more clear because you can see that we do have a red 30-day moving average in this case, telling us price is below a falling moving average, which is a more bearish feature. It's more decided that the path of least resistance is to the downside. Now, obviously, things change. That's the nature of markets. They are cyclical. But for the time being, if you're kind of out there flipping coins trying to figure out which side to be on with the Dow stocks, right now you're still on the bearish camp if you trust price. And right now, I think it's a little bit more evident than we've seen at other times as well, simply because yesterday we took out that prior low. Notice that when I was with you last on Tuesday, right here, we had not yet taken out the low of that candle and that candle back here in December. But with yesterday's continued selling, at least early in the day, before rallying for the rest of the day, you were breaching those prior intraday lows over there. And you'll notice that the Dow is the only one that can make that claim. In fact, for the Russell 2000, you're actually still closer to the highs of the 3-month time period than the lows. And the Dow literally just hitting new lows yesterday. So there's a lot of differences between the major markets right now. And that's just one case in point that we're seeing right there. Of course, we've been talking about this for many weeks at this point, so that should come as no surprise to anyone that the Dow has been our laggard in this most recent pullback that we've seen here over the last month or so especially. So that's where things stand right now, remaining with the bearish postures across the board, but a nice rally for the bulls here today to try to stabilize things, and we'll see where they want to head as we go towards the weekend here, with tomorrow's trading being the first Friday of March. And although I didn't hear anybody talking about this today, partly because I had a very busy day, as today is a day where I teach a 3.5-hour class, so I was kind of out of the news flow like I normally would be. But anyway, tomorrow is the first Friday of March, and typically the first Friday of every new month is Jobs Friday. And so that does have the potential of making some movements within the market. And remember, the market's chief concern right now is simply what is inflation and what is Jerome Powell going to do about that inflation. And one of his thorns in his side right now, as strange as it is to say, is that too many people are employed. The more people that are collecting their paychecks means the more people that are still spending money without any thought in the economy. And while that sounds like a good thing on the surface to the average person, for all of us investors and traders, we have to think about what that means from a consequences perspective as well. And it could very well end up emboldening Jerome Powell even further to be pushing interest rates up higher and higher and higher. And at least earlier today when we were in class, I know that the 10-year was well up above 4% already. So we'll see what tomorrow brings. If there's not much in the way of enthusiasm around the employment numbers, then maybe that's an excuse for the markets to rally. On the other hand, if it seems like the unemployment rates are extremely low and pretty much anybody who wants a job can have one, then that's probably not something that the stock market is going to look at too kindly in this current atmosphere, as strange as that might sound. Let's take a quick peek here at our 3 green arrows strategy, see what we can find there. And you can see here that we remain with 3 red arrows across the board. This is chart 4D for those of you following along at home. When the background color of these charts is pink, it means that we have 3 red arrows, and it's just kind of a colorful way to describe the bearish conditions with 3 different technical indicators, with the 30-day moving average being one of those, with the MACD histogram being one, and with the stochastic being one. So in all 4 of these charts, we do remain with that bearishness in a 3 red arrows capacity, as well as having the bearish postures according to the market forecast technical indicator. And then let's take a look at a longer term chart now and look at our 1040 crossover. So this is chart 4C here for those of you following along at home. And remember that this one is a little different than the other charts in that this one is going to have charts that are 3 years in length, and each one of the candles is going to be 1 week. So it gives us a kind of a broader view of what's been happening. Of course, last year was a quite dramatic year in the stock market with stocks going down precipitously throughout much of 2022. And so we can see that here on this chart, whereas we can't really see that on the 3-month charts that we were just looking at a moment ago. So not a lot has changed since the last time we looked at this together, but one thing that does catch my eye is that it appears up here on the S&P 500 that we're getting awfully close to going back to a death cross. I know that sounds pretty scary, but all that means is that the more sensitive line, in this case the 10-week moving average, is crossing back down below the 40-week moving average. It was showing some bullishness for a couple of weeks, so that's why the background color went from pink to green here, but you can kind of see a little bit of controversy right now. And remember, there is still one more day this week, so if we have a rip-roaring rally, that can change, but keep your eyes on that. It looks to my eye like there's a pretty decent chance that within the next couple of weeks we'll be going back to a death cross on the S&P 500 after having just a couple weeks with the golden cross. A couple of these others are still in reasonably good shape. The Dow, believe it or not, even though it's struggling in the shorter term, from a longer term perspective, because it didn't go down as much as the other indices last year, is still with that golden cross, and it's had it really since going back here to November of last year. So we're a good 4 or 5 months into its golden cross zone here, despite the turbulence that we've seen here with the mega caps here more recently. So we shall see, but right now it looks like that one's probably good to go for another week or two. The Russell 2000 is also impressive, and unlike the Dow, it is actually gathering some steam here from this perspective. I know it's really hard to see for you guys, especially if you're watching this on a phone right now, but if I were to right click up here, notice the orange 10-week moving average line is tilted lower on the Dow. And then when I go back and look at the Russell, notice that the orange line had been going up. It's a little bit more sideways right now, but it does look like there's at least a little bit more bullish momentum here on the Russell 2000. And given what we know about the last 3 months, that seems to make some sense there. So it seems to me that they're probably going to be good to go for another week or two as well at a minimum. The NASDAQ, of course, is the big difference here of these 4 charts, because it's the only one that has not yet turned to a golden cross. And the reason for that is it was so far out of favor in 2022 that despite having a pretty good 2023 so far, it just has a much longer journey to get back to those levels, whereas these other indices didn't fall as much to begin with, so it was easier for them to get back. So the NASDAQ, similar to the Russell 2000, has had a little bit more buying pressure than some of those other areas. So I'm not counting it out at this point, but it is maybe a little bit unfortunate that it seems like it's kind of stalling out here in the last couple of weeks, because it had some decent momentum behind that orange line here maybe 3, 4, 5 weeks ago, and now as soon as it gets up to the blue line, it's just starting to kind of go sideways. So it's giving us a little bit of a head scratch there. We're not quite sure what it wants to do, but there is definitely some stalling out in that perspective. On a seasonality perspective, they do say that typically the beginning of March is a little bit more bullish, right? February and late February is typically a little bit more bearish. So from a calendar perspective, maybe that assists the bulls right now. But of course, things do change. Every year is a little different from the prior one because the news is different and what the investor focus is different and all that kind of stuff. So we'll see if that makes an impact or not. But right now, what catches my eye is that it looks like we're going to be transitioning back to a death cross on the S&P 500. All right, let's go ahead and stop on over here to the internet I always like to get a chance to say thank you to those of you that help support our presentations. A reminder that we do these for free, and they usually take up about 3 hours of our day. And oftentimes, at least for me, I can't speak for David because he does his videos at different times than I do, but for me, I'm usually doing them after the market closes and during when I normally would be eating dinner, not to make you feel guilty or anything like that, because of course I'm making that decision for myself, but I do make personal sacrifices to be with you guys and produce these videos and hopefully give you a good experience and get these videos out as early as possible as well. So I appreciate your support and your acknowledgement of that. You guys have been great for me over time. I really appreciate that, and it's no surprise that you guys stepped up to the plate nicely. The last time I did the video on Tuesday, 131 of you clicked like. How about that? That's one of our better counts that we've had. Usually as I always say, as long as we're up and over 100, I'm happy. But usually we kind of max out on these things maybe around 120, 125. Every so often we can get up a bit more than that. But this last one, you guys really stepped up. So appreciate the extra folks that kind of came out of the woodwork there for me that normally don't click like. That goes a long way. Remember, for David and I, we're just a couple of guys trying to make a go of it in this world. We don't have much in the way of a marketing budget or anything like that. What we have is social media, and we have a lot of enthusiastic and loyal supporters, and I'm proud to go to work for you as often as I get a chance to. So let's do some shout outs here. Thank you to Curdy and to Vernon and Randy and Andrew and Eddie and Nietzsche and Barry and Ray and Irene and Keola and Niranjan and El Zulu and Austin and Neil and Dean and Jim and David and Rob and Ash and Carlisle, Greg, Joel. Let's see, we got Bill and Business News and Rich and Word on the Tweet and Rick and Sherry, Judy, Julie, Thomas, Trunk, Robbie, Claire, and others. Appreciate all of the effort. I can't get to all of you, but I really do appreciate you guys taking the 5 seconds out of your day to help us along with that. Goes a long ways. Earlier today, we had a great day at Market Scholars, as we always do. I taught my question and answer session, as I mentioned, spent 3.5 hours this week, which was easy peasy for me, considering we went 4 hours and 40 minutes last week. But normally I have to be maxed out at 3 hours and 30 minutes because David needs the WebEx platform after that. So it kind of saves all of us for me going on all day. But we still had some great conversations today nonetheless. Got a question about the comparison of buying short-term treasuries versus selling cash-secured puts in an IRA and some of the considerations there of, risk-free investing with the U.S. government versus taking on risk by selling puts on individual stocks, and then comparing some of the return prospects, and kind of wove in some of Warren Buffett's shareholders letter to help answer that question as well. Also got a question about looking at Baxter as a dividend growth investing candidate. And for those of you that watch most of my videos here, you'll know that we actually have an open sold put trade on Baxter right now in this market outlook trade account. And so anyway, that one's doing pretty well for us. Remember, it's been really out of favor, but we were fortunate enough to sell it into some really high volatility at the time and gave ourselves enough room to withstand a further push lower in price. So that one is actually in good shape. We are profitable on that trade, just like we're profitable on our Norfolk Southern sold put trade. And I know a lot of people probably thought I was crazy for doing the trade at the time, because of course that was very controversial, as Norfolk Southern was very much in the crosshairs in terms of poor public opinion, and rightfully so. Remember, just because I'm doing a trade on a stock doesn't mean that I support what they stand for or different things like that. But sometimes it's helpful to go in there and take the opposite side of the trade that everybody else assumes is totally obvious, right? That it should be going down, it shouldn't be going up, and this kind of thing. So sometimes our charts and our knowledge about dividend background can help us with those types of things. We had a good discussion there about Baxter here today in that question. We also had a question about Dow Chemical. We talked about the wall of shame and the old CEO, Andrew Liveris, and how he lied to everybody, saying that he would never cut the dividend. And then within a half a year, that's exactly what he ended up doing back in 2008 and 2009. And also here more recently, Dow is one of the rare Dow Jones Industrial Average companies that just refuses to raise their dividend. They've been paying the exact same dividend here for the last, let's call it 5 years or so, ever since that Dow DuPont spinoff type of activity. So doesn't really fit as a dividend growth investment, even though it does pay a substantial dividend itself. So that's another topic that we had today. We also had a conversation about how to interpret the option chain and some of the product depth and call and put delta at the bottom of that thinkorswim platform, and some of the uses for that. As I told Boss, that's not something I personally use a whole lot, but our classmates are all in good spirits about that, and they just kind of want to pick my brain and say, hey, do you know anything about it? And if you do, let's hear what your thoughts are. And so we got a couple of articles out and kind of walked through some of the statistics and things like that, and see if there was anything that we could find as useful information in regards to how to interpret that. And then I also got a question about Home Depot and how it's been down after its earnings that it had here a couple of weeks ago, and talking through why sometimes stocks go down even though they beat earnings estimates, and whether this might be turning into a buying opportunity or not. So if you have any interest in those topics and you're a premium member of Market Scholars, that is posted to our Trading Rooms calendar. And remember that David taught his portfolio management with ETFs class today as well, and I'm sure he did a great job with that. So feel free to check out those extra pieces of content if you've got the time in your schedule. Tomorrow, David should be back in action with his technical analysis class. Let's also have a conversation here about the factor selector. So this gets done on Tuesdays, or I should say it gets put together based upon Tuesday night's closing price information. I then post it to the website on Wednesday morning right before my factor-based swing trading class. And we didn't really see much in the way of changes this time around. You can see that our bookends, as we refer to them, number 1 and number 6, remain the same from the prior week. The low size factor remains number 1, and momentum remains dead last. And we look for trades based upon that knowledge in my factor-based swing trading class. So our bullish trades will be holdings of the low size ETFs, and our bearish short selling trades will be ideas that come from the momentum category. Anyway, low size, as a reminder, the best kind of broad index, kind of corollary there would be the Russell 2000. And as we just mentioned here a moment ago when we were looking at the foregrid, remember that the Russell 2000 has been doing a pretty good job of being a leadership group at a high level, so it makes sense that the low size factor is doing pretty good versus its competition there as well. So the only change we had week over week was between low volatility and dividend yield, and both of those I think are kind of struggling from the same thing right now, mostly rising interest rates. They are surging here recently, and a lot of times when you have bond-like proxies like utilities and REITs and different things like that, they're going to do poorly on a relative basis as a result of rising rates. So I think that's kind of hurting both of those areas right now, but naturally one has to do a little bit better than the other, even though both of them could be kind of underperforming at the moment. All right, also wanted to quickly just point out that I just got done putting together the dividend growth investing post for the month of February. A reminder that if you're looking for this on our website, sometimes you can find it over here under the popular recent blog post, but I don't have any control over that because that's done automatically by our website. If people are clicking on something a lot, it shows up over here. So right now, since people have been clicking on this here in the last couple of hours or whenever I posted it, then it's showing up here. But even if you come to our website and you don't see it over here, you can always find it under the blog area. Hover over blog and then go to dividend growth investing. Remember, that part of our website is free, regardless of whether you're a premium member or not. And so we kind of operate under under that freemium, business model where we do offer plenty of things like this YouTube video and some of those posts on our blog for free. And then our other stuff like our classes and our scripts and all that type of stuff is what our premium members would receive when they actually join our program. So anyway, feel free to check that out. It was a doozy of a post. It's part of the reason I'm doing this Market Outlook video a little bit later tonight, because I wanted to get this posted, and it took a lot longer than I assumed it would, because there were so many stocks. I mean, holy mackerel. Take a look at this. Remember, February is a short month from a day's perspective. There's only 28 days, but that didn't stop corporate America from going to town and announcing a whole boatload of different increases. If I counted right, I think there were 135 increases. And those are just companies that had already increased their dividend 5 years in a row. So in other words, there's probably dozens of other companies out there that only raised their dividends previously 1, 2, or 3 years that also raised their dividends in February that are not being accounted for in this graphic. So this is one of the bigger months during the whole year that you will ever see this many dividend increase announcements all at once. Remember, most companies only increase their dividends once per year. And so it is not usually evenly distributed throughout the 12 months. Typically what you find is that the beginnings of the year are where you see the most amount of dividend increases, because that's typically when your boards of directors are gathering together for kind of their once a year powwows. And so anyway, lots and lots and lots of increases here. I'll plan on going through my interpretation of these increases in my classes early next week for those of you that want my insight on it. But otherwise, feel free to spend some time on this either on our website where I showed you, or otherwise I also just got done posting it here to Twitter as well for those of you that follow me on Twitter. All right, let's go ahead and pop back on over here to the Thinkorswim platform. And let's take a look at some more charting analysis with our 12 grids. Let's get over here to chart 5A. This is our asset class 12 grid. And you'll notice that we have a few fewer green charts than we did on Tuesday. Or it might have been the same. I can't remember. I'd have to look back for sure. But anyway, the point is there's still way more red charts than green charts. And you can see that the story of the day from my perspective is what I already hinted at here a moment ago. Treasury yields just went bonkers again today. Take a look at the chart in the lower right-hand corner. In fact, I'll right-click and maximize that so we can see it a little bit better. This is an epic move here. This is a gap up. Just a huge, huge move. You can see that we are now at the highs for the 10-year Treasury yield over the last 3 months. And how you read this on Thinkorswim, for those of you that aren't aware, you just move that decimal point over to the left one. So in other words, where we ended today was 4.07% on the 10-year Treasury yield. And that is amazing. Let's see if we can go back, let's say, a year, and you can see that we are starting to approach those really difficult areas that we were dealing with back in the fall. Remember, back in the fall was the time when the stock market was getting hurt the worst. It wasn't until I think the end of October, beginning of November, that we started kind of more bullish types of rallies again. But we were selling off aggressively into the fall. And a big reason that we were doing that was because this is how the Treasury yield market looked. It was going up day after day after day. It was relentless. And all of a sudden, we're knocking on the door of those prior highs once again. In fact, I think David had a pretty good tweet on this earlier in the day. I might have retweeted it as well, but he was talking about how close we are to those highs, yet the stock market is nowhere near its lows. And, the question is, what's going to give? Because usually those two things aren't going to stay separated from one another. And I'm sure, David's probably thinking that what's going to give is the stock market is going to give to the downside and get back to where it was in the fall, if Treasury yields do end up kind of eclipsing these prior highs that it had back here. And remember, there's a pretty decent chance of that. Right now, the 10-year is still only at 4%, Yet a lot of the indications out there suggest that there's a high likelihood that we're heading to 5% if you're looking at it through the futures market, and just looking at it through what Jerome Powell is saying with his interest rate policy in the short term as well. So it's definitely a doable situation here. In other words, we could get to new highs in Treasury yields, and if we do, yikes. The market, I don't think, is going to appreciate that all that much, judging by what happened last year. So, brace yourself. And that's why we try to have the wider variety of trading ideas and different things like that we present to you in these videos, because we do want balance, right? We don't want just nothing but bearish trades. We don't want nothing but bullish trades, nothing but sideways trades. We want a healthy mix of them, so that way, we have a better chance of surviving whatever the market throws our way, even if we aren't going to be perfect at all times, right? We always know we're going to have, mistakes and failures and things like that, and that's what every trader and investor has to deal with. I spent some time talking about that psychology today in my Q&A class. It's essential for you to learn to live with your mistakes and hopefully learn to improve based upon what you learned with the mistakes, because if your goal is to avoid mistakes, then you're in the wrong business, because mistakes are almost guaranteed to happen when you start stepping into the stock market and options markets arenas. So anyway, it's how you handle mistakes that really will dictate your future success. And the sooner you can learn, the better off you'll be, or at least that's what my philosophy is. Anyway, of course, when Treasury yields are surging higher, typically what you find is bonds are selling off. And that is what we saw today with long-term U.S. Treasuries. They were down about 0.89% today, and you can see that we did eclipse that prior low. We talked about that a little bit on Tuesday, and at that time, it was on that candle, we had not yet eclipsed that. So, there was maybe some hope that we could kind of hold the line, but that just did not happen. It wasn't in the cards, and here we are today pushing through that area. So as the 10-year Treasury yield went to new 3-month highs, the long-term Treasury bonds themselves went down to 3-month lows. Now, these are the long bonds. We actually talked about the T-bill ETFs in my Q&A class today. That's a whole different conversation entirely. You don't have as much directional opportunities with the shorter-term bond ETFs, but there are still very nice cash reward environments available in the short term in terms of the income that some of those bond ETFs can pay you. So for those of you that are kind of stuck in your broker's cash sweep vehicles where you're earning next to nothing, be aware that there are plenty of products out there that can get you up there in the range of 4 or 5% without taking a whole lot of risk. So anyway, that was a good discussion we had today in class as well. The other chart that is dark green down below here is the US dollar. It is up another 0.5% today. Remember, it was already in that bullish territory on Tuesday, and we were talking about how as soon as the dollar started going up, the stock market started going down. So again, not a good sign when you see that. Typically, today it seemed like there was enough of a beat down that the stock market took previously that it was able to kind of withstand the pressure of a rising dollar. But in general, that trend is in play right now. The dollar is rising, stocks are falling, so we have to be a little bit more cautious in this environment. Typically, when the dollar is strengthening, you have weakness in commodities. That is what we see out of gold. Gold was down again today, not by much, but down just a little bit after having this oversold cluster signal and then a bit of a reversion to the mean here in the 3 days after that. Today you gave back a little bit of that, and remember, we still have that falling 30-day moving average on gold, so all else being equal, the path of least resistance remains to the downside. Oil's a little bit trickier to figure out because it seems like it's just comfortable going sideways. It doesn't want to make a direction right now. It's just going next to nowhere. It's doing it in some pretty wide chops there. So for those of you that have managed to play the bounces off the lows and also the selling off the tops, you might have had some swing trading opportunities there. But if you're looking for a bit more trend from an intermediate perspective, you're probably stuck right now feeling a little bit disappointed in oil as it's really not doing much of anything. You can see that Bitcoin is holding its own. It was basically flat today, but it remains above 23,000. And, we've had some pressure in other risk assets here recently, but Bitcoin has done a good job withstanding those pressures. It kind of felt like there was a calling of the herd of sorts when the whole Sam Bankman-Fried thing went down. And it seems like, those that remain standing kind of received the benefits of that, while the weaker ones were washed away. And so Bitcoin, of course, is the kind of the oldest school, if you could call it blue chip, cryptocurrency out there. And so maybe it benefited when some of those sketchier areas like the FTX tokens and even the other exchanges started suffering. Sometimes people, rethink things and say, you know what, Bitcoin's even more attractive in that environment because it proves the point a little bit more. So we shall see where that takes us. But for right now, definitely impressive that it's been able to hold those really robust gains that it had right out of the gate to start the year. We've largely been going sideways for the last month or so, but the fact that it didn't unwind that massive move is pretty impressive, and it remains above its rising 30-day moving average right there as well. In terms of the top rung, you can see that foreign stocks were up today as well. However, they were not up as much as the U.S. stock market. And again, that could be attributed to the rising U.S. dollar. The dollar was up today, so all else being equal, you would assume that foreign assets would do a little bit more poorly than U.S. assets. And that was the case here today. So you can see EFA, which tracks Europe, Australia, Japan, etc. It was up 0.2%. And then EEM, which is the emerging markets, tracking China and India and Turkey and Mexico, a few of those others, it was up 0.36%. So both of them easily underperformed the U.S. markets, which were up over, 0.75% there. Preferred stocks rolled over here today. In fact, that's starting to look a little sketchier here all of a sudden. Preferred stocks were down 0.42% today, and notice they now have a red moving average, and telling us that price is below a falling moving average in this case. And today's candle at its lows did breach the lows that PFF had here on February 21st and 22nd. And so it kind of seems like this is carving out, at least in the shorter term, a series of lower highs and lower lows after having a spectacular start of the year where it was up basically every single day for the first 2 or 3 weeks. So now we've unwound a big chunk of that move, not all of it, because we started right here at the beginning of the year. So we're still way up for the beginning of the year, but clearly it's not quite as robust of a return performance as we were looking at previously. Let's go ahead and take a look at our sectors now. And that is chart 5C for those of you following along at home. And here you can see that we do have the industrials as a dark green chart here. And remember, industrials was the sector that was ranked number 1 on the sector selector when we reviewed that information in Tuesday's video. Of course, the sector selector is put together on Fridays, so tomorrow night I'll be putting together a new edition of that, and based upon what I see right now, I have no reason to believe that industrials can't retain their newly found position up at the top. Remember, industrials had overtaken consumer discretionary in that regard, and they remain pretty resilient. As you can see here, a really nice day, up 1.17%. That was one of the bigger movers. Oddly enough, the bigger movers today were the defensives. Down below, the staples were up 1.37, utilities were up 1.89, and real estate was up 1.3. And I think that's, while that seems good on the surface, it's mostly because they were so out of favor. We've been talking a lot about that in my classes here recently, that as a dividend growth investor, typically my go-to areas in the market to hunt for new opportunities is those sectors that are in that bottom rung. So healthcare, staples, utilities, and real estate. And oddly enough, those are the areas that have been most out of favor in this current move in the market. and therefore we've had more opportunities to put new money to work. So those areas are really suffering with a downtrend. Obviously, trends don't last forever, so somebody who's buying a stock that's in a downtrend is hopeful that over the longer term, they will be rewarded for buying a stock that's cheaper, not more expensive. But of course, that's easier said than done as well. So for our purposes here, because this is more of a trading-oriented presentation as opposed to investing-oriented, just be aware that you're still playing with fire if you're taking bullish trades in these areas. You can do it with, the proper type of position sizing and risk management in terms of strike selection and different things like that, like we did with Johnson & Johnson here recently. But, if you're looking for quick little movements, you're probably seeing that that's not going to be as easy on the bullish side right now as it could be on the bearish side for those areas, because all four of those charts on the bottom rung still have those strongly bearish postures. So industrial is the only one with strongly bullish. Materials and energy actually have that light green background color, telling us that we have weakly bullish postures, not quite strongly, but I would imagine it's not going to take long for materials to get there, because that was a nice move out of materials up and over that rising moving average today as well. In fact, let me right click and take a look here. Yeah, I would imagine that by tomorrow we're going to be back to a dark green background color on materials, unless it just really falls on its face tomorrow. And I say that because this green line is just about to cross that midpoint of that market forecast technical indicator. It's at 45 and rising right now. So if we have another up day in materials tomorrow with XLB, at least, this is the market cap weighted one, then there's a pretty decent chance that as soon as tomorrow, materials will be joining industrials with a strongly bullish posture. Whereas energy, it's probably got a ways to go, right? Energy, you can see it's had a nice little rounded bottom here, and it's trying to work its way back to the moving average, but it looks considerably different than the way we're looking at materials and industrials right now. Those two are much stronger. With energy, if we were to look at it, you can see that it actually just got out of the low reversal zone right now. Remember, it would have to go all the way up here to 50 in order to get that dark green background color. So not only do we have a ways to go, if this one wouldn't have closed as well as it did today, it could have still had a pink background color. It just barely got out of that lower reversal zone there. So energy still has plenty of work to do, despite what appears to be at least some optimism with that light green background color there. In terms of who today's worst performer was, I see discretionary was down, but it was financials. Remember when we were looking at the heat map earlier, I was saying that the financials caught my eye, especially the big banks, JP Morgan and Wells Fargo, and all those companies seem to be down today. So that pressured XLF here, and it was the worst performing sector, down 0.48%, and now has a dark pink background color, indicating strongly bearish posture. Okay, so that's where we stand there with the sectors. Let's go ahead and now jump into our trade application example. And I'm just going to bring up our swing trading chart now. And first of all, it's kind of interesting to note that we're not taking a trade here on SPY itself right now, but I will point this out because it is somewhat similar in at least one regard to the trade that I will be showing you here in just a second. This is SPY, of course, the ETF that tracks the S&P 500 index. Notice that we had a nice bullish engulfing candle here today. Not only that, but it was a big enough move from low to high, because remember, we were down on the day early on, and we rallied all the way through the rest of the day and closed pretty high up. Not exactly at the top of the day, but close enough, right? That's a pretty impressive candle that we're looking at right there. And you'll notice that that was enough of a favorable move there in the short term that it was able to move this blue line higher. So that's what we also refer to as the near-term line. And you can see that it's now at 48 and rising, and therefore that is considered to be bullish at this moment. Now, obviously, we're still below the moving average, so we've got work to do. It's not like we're off and running to the upside here. There's still plenty of debate back and forth, but at least in the true short term, there's at least some optimism there. And what's interesting about this is we do have what's known as a bullish near-term divergence signal here. And I'm assuming that's the same on the S&P 500 itself. Let me try SPX and it is. So both of these, whether you're looking at SPY or SPX, you can see that we've got this trough in the blue line down below here on February 22nd. We have this follow-up trough right here yesterday on March 1st. So we had a higher low on the blue near-term line down below. At the same time, the two price candles associated with those levels, which is this one right here and this one right here, went down. So we went down from here to here. At the same time, we went up from here to here. So there's a divergence taking place between those two things, and we would identify that as a bullish near-term divergence. So maybe that is an excuse that the market can have to have a little bit more bullishness, at least in the ultra short term, right? We're not talking like, hey, trend changing type of a thing, but it's possible this was a little bit too much of a sell-off that we had here in the last month. We might need to give the bulls their day in the sun. And if they get it, then perhaps having some more directional bullish trades could be useful as well. And so I'll show you what I picked out here today for us. This is Cisco Systems, obviously a well-known company, ticker symbol CSCO, not to be confused with the food Cisco, SYY. This is the tech-oriented one. And we talked about this one a little bit here a few weeks ago when they reported their earnings. Not a whole lot, but at least made the comment when we were going through our heat map that particular day that, you know, Cisco was one of the best performing stocks in the market because of how they reported their earnings. And you can see here they reported their earnings on the 15th of February, and they reported 88 cents. The analysts' expectations were 75 cents. So they had a nice 12 or 13 cent beat there in this particular case. And that caused a rapid rally in the stock price basically overnight. You know, it just kind of shot up. And remember, Cisco is not typically the type of company that would do that. You know, you have other tech players that are more prone to that type of behavior, but right now the world kind of perceives Cisco as a stodgy, old school tech player, not one of the exciting new ones like a Salesforce.com or something like that. So that was a little bit out of its character. Well, of course, we know what's happened in the stock market since then. The stock market sold off, and Cisco's shareholders used that as an excuse to give back those gains that were probably warranted, right? It's not, you know, we're talking about billions of dollars at play here with Cisco when it pushed that stock price up as much as it did on its earnings announcement, and they gave all of that back within just the next week, right? The next 5 trading days or week went straight back down and filled in that gap. So we had that huge gap up. It looked like we were off to the races, and then the stock market sold off, and Cisco was no exception to that. They sold right back off as well, filled that gap right there. And now ever since filling that gap on this day, notice what's been happening with price. It's basically been going sideways. And Cisco has refused to breach the 30-day moving average in any major way. It's flirted with it a couple of times, right? You can see that the long lower shadows are going through the moving averages, but it never closes below the moving average. So to my eye, that looks like it's a pretty strong support area at this moment. The other thing that I was going to mention, which it shares that commonality with the S&P 500, is it does have a bullish near-term divergence signal. And it's probably the same day as it is. It's got February 22nd right here where you had that trough in the blue line. You had a follow-up trough here yesterday on March 1st, and obviously that went up. So this level right here is lower than this level right here. And the two price candles up above associated with those two moments are this candle right here and then this candle right here. So clearly price went down at a time when we showed an underlying improvement on the underlying indicator. And you can also see that with today's move, it was enough to change that background color of the chart back to blue because that near-term posture is now bullish once again. You can also see that we had a bullish engulfing type of a candle here. It might not have been as obvious as the S&P 500, but at least from the body's perspective, this red body right here was fully engulfed by today's body. So we didn't quite have a Cahold. It was awfully close. In fact, earlier in the day, it looked like it was going to have a Cahold. In other words, a close above the high of the low day, with yesterday being that low day. But we did sell off a little bit in the second half of the day. So although it was still a pretty solid session, we didn't quite get the hold pattern there. What I ended up doing with the trade example, remember I do these trades when the stock market is open, so that way I can send all of you guys who are premium members all of the trade details and the screenshots and all that kind of stuff. And so what I did in this case was I just bought the stock, right? I actually tried to look at some of the options, but what I didn't like about it is a lot of them were trading with $2.50 between the strike prices, at least on the monthly contracts. I could have gone to the weeklies, I suppose, but I just chose not to in this case. But originally what my plan was actually to look at the iron condors, because this is the type of chart that I think also makes sense from that perspective, where you've got some pretty obvious peaks in the past, you've got some pretty obvious troughs in the past, and where you're at right now is directly between those two levels. So, if there was a little bit more volatility and I could have been a little bit more comfortable taking the iron condor, I might have gone that direction, but it just wasn't shaking out the way that I wanted to in the return numbers. So instead, what I opted to do is, hey, let's take a somewhat rare directional bet here on the long side of the market. Just bought the stock outright in the paper money account, and I'm hoping it gets up to this level here where it was trading back here on the 27th of February, so about 3 days ago. And I put my stop loss down here a little bit below yesterday's low. So if we can bounce up and off of this moving average, there's a pretty decent chance that we can get up to our price target. But as you can see, this one's a little bit more dangerous than many of these types of trades that I put on because of how tight the stop loss is. Usually I'm going to have a little bit more wiggle room there. I'm going to cast a wider net. But in this particular case, I decided to keep it tight. That could come back and bite me. Who knows? On the other hand, it can be a benefit because remember, I typically do a one-for-one reward-risk relationship. So the tighter your stop loss is, on the plus side, the closer your price target is, and the wider your stop loss is, the further away your price target would have to be. So if we happen to get a little bit of a short-term burst higher in the stock market here in the next few trading days, then this one could be a beneficial trade for me, even if a month from now we're trading lower than where we are at this exact moment in time. So we kind of need a short-term pop in the market for this one to work out well. But for many of you, this is probably not going to be your perfect setup simply because you're a little bit nervous about the general market conditions, and this is a really tight stop loss. Maybe some of you would take the trade but adjust your stop losses a little bit wider. Obviously I show you a way, I don't show you the way, so all of you can adjust accordingly based upon what your thoughts are. But I at least thought it was a fairly good example of a company that did a gap fill, that did a bullish near-term divergence that's clearly showing us a bounce up and off of a rising moving average, and also is trading above that rising moving average with the near-term bullish posture that we have right now as well, or in other words, that blue background color there. So, maybe it's an opportunity, because for a while it looked like this stock was just going to take off after having that earnings announcement. It was a really impressive number, and some people might have been thinking that day, oh my goodness, there goes Cisco. It's going to leave me behind in the dust. Well, here's your second chance, right? It's come right back down. In fact, it is now trading pretty much exactly where it was trading the day before it reported its earnings, but it's stabilized for the last week or so right around those levels. So I just thought the chart pattern was pretty interesting in that case, and wanted to present that for us here in Paper Money tonight. Okay, so that's what I had for you. I hope you enjoyed the presentation. If you did, as always, I ask one simple request out of you. It doesn't cost you a single penny. All it does is takes 5 seconds out of your time. Just click like for me there on Twitter. Remember, you can do that in 4 different places. You can either do it when it's pinned directly to the top of my Twitter timeline. So for those of you that are on Twitter a lot, that'll be the easiest way for you. You can also do it if you're watching this video right now on the Market Scholars website. Directly below the video, there will be a little Twitter widget that you can click on the heart on. You can also get the tweet in question by going into the description area of the YouTube video itself if you're watching this directly on YouTube. And then the last place is on the distribution emails that we send you guys. There's a little Twitter icon at the bottom, and if you click it, it'll take you to the tweet in question. So whatever you choose of those 4 different options, it all takes you to the same place, and your like gets counted alongside everybody else's there. If we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll plan on doing another full-length video like this with all the 12 grid analysis and all the selector analysis and doing a trade application and all that kind of good stuff. On the other hand, if you prefer the shorter videos and you only want to hear 15 minutes worth of analysis, then don't click like. And if we're under 100 likes, then I'll keep it nice and short and sweet for you on Tuesday. So we'll let you guys decide collectively on that. Regardless of what you decide, I appreciate you checking out the video here tonight. David should be back with you tomorrow. So I want to wish you all a wonderful weekend as well, and I'll see you all on the flip side. Best of success with your trades and your investments. Goodbye for now.